and Bank of America's TARP repayment sends a signal of financial strength to the government, its shareholders, and the entire industry. So how do the other banks measure up? Matthew McCormick is a portfolio manager and banking analyst at Bahl Gaynor, which is $2.5 billion in assets. There's Matt joining us live from Cincinnati, giving us his assessment today. Great to see you, Matt.
Hi, Lori.
Let's set the stage here. The Obama administration today said it expects the TARP to be $200 billion less than projected. So do you think the program has been a success?
I'm not a PhD student, so I think it will be debatable, for many years to come about the use of government funds to promote, propping up some industries. Is that capitalism or not? But the point is, the facts are that the banks are still surviving. There are ongoing entities. Some will be in TARP longer than expected. I am somewhat suspect of the, quote, money saved, especially in the TARP program, when you have some entities that were obviously successes, some like AIG, GMAC, and GM, and even to a certain extent, Citigroup, I question how profitable that investment for the government will be. So I think short term, I give the TARP a C. Long term, it's still up in the air, Lori.
Appreciate your assessment on that. Want to dig into, drill down, if you will, on Citigroup. Today, Bloomberg did learn, I think you're referring to this, Treasury will hold off selling its 34% stake in Citigroup until the bank and regulators do agree on a plan to repay all that $45 billion in bailout. Treasury's worried that a share sale could actually weaken investor demand. Do you agree?
Absolutely. You look at Kuwait today selling $4.1 billion of their profitable investment. And I think if you look at Citigroup, that was essentially the poster child for the TARP plan. They essentially did everything wrong and deserved to be the most penalized and be in the TARP for the longest. And when you look at really what the debate comes down to, Lori, is there's $300 billion of what is called questionable securities, which the Citigroup paid $7 billion to write for 5 to 10 years of guarantee. These are issues like commercial real estate, autos, mortgages, other devalued assets. And when you look at this from a political perspective, there is no political appetite for banks going in or out of TARP. Once they're out, they're never going to come back. And the Treasury has to make certain that if they let Citigroup out, essentially, for the argument here as well, because BAC got out, we should be out too, they have to be absolutely certain that Citigroup can stand on their own 2 feet. And I think that's debatable. Citigroup wants to have it done essentially by the end of the year. I think it probably could happen sooner than expected, but I'm a little bit suspect on whether or not, it'll be done by the end of the year.
And in your research, you put Citigroup in a class of its own. That's how you characterize it. So Citigroup, how weak is it to its competitors from an investment perspective?
It depends, on who its competitors are. If you look at Goldman Sachs or J.P. Morgan or Morgan Stanley, certainly they're lower than them. If you look at companies like U.S. Bank or Northern Trust, PNC or Wells Fargo, they're certainly lower than them. I think also they're slightly above some competitors, especially because of their Smith-Barney efforts, which I think are basically doing their job. But I think when you look at essentially all that has gone wrong and how difficult it is for them to get out, it's going to take longer than expected. So I think Citigroup, again, is the personification of the TARP plan. It is something that I think they had the most sins. It's going to take the longest for them to be forgiven, and the government has to be absolutely certain they can stand on their 2 feet, because I think, unfortunately, or not unfortunately, but I think if they go through where there is a double dip or Citigroup gets in trouble, I do not think they're going to come back and have the appetite to rescue them again. I think they are very, very cautious about this, and its prudence will work on this case, in my opinion.
Now, do you think the Bank of America TARP return was good for shareholders?
Absolutely. I think if you look at the fact that it sends a strong sign that BAC has some stability, not only in terms of its current cash flow and earnings, but it now allows them to go out and get a new CEO. It gives a very strong 1-2 punch that Bank of America is going to be in a much stronger position going forward. Certainly it's dilutive. Certainly they're going to have raise some capital. But I think long term they're going to have their way to grow themselves out of it. And I think it'll pay for itself by attracting and retaining great talent. And I think that's one of the reasons why Citigroup wants to get out of TARP desperately, is they see all of their competitors getting out of TARP, and it allows them to take off the pay plan's shackles. And if Citigroup is the only one of the big banks that has these pay restrictions, it's certainly going to be at a disadvantage. So I think it's very positive for BAC. It's positive for the banking industry. And obviously, Citigroup wants to partake in all the reindeer games.
Among the strongest banks out there, those in the best position, Goldman Sachs, Morgan Stanley, J.P. Morgan, no one probably argue with those three. Which do you think, though, is the best investment?
I think Goldman Sachs, if you look at banks as a whole, since March 6th, the XLF, the ETF, is up 137% since the March low through yesterday. And so I think banks are looking a little bit tired, especially since October. Goldman, I think, is probably not the best investment going forward. If you like financials and you want to play the bigger banks, I think JP Morgan and Morgan Stanley may be of interest, mainly because they don't have the same PR issues of Goldman Sachs. Though they have the same profits, business practices, and bonus structures, they're not taking the political heat as much, Lori. On the other hand, in terms of the financials that we do own in our discretionary portfolio, we like BNS, which is Scotiabank. It's based in Canada, has a great yield, no exposure to the U.S., has strong emerging markets area. I like the fact that it doesn't have the issues or the leverage to U.S., and I think it's a great bank and a very conservative, frugal culture, as well as a very frugal business plan as well.
Let's move on, talk a little bit more in detail about the regional banks. I was reading a Bloomberg story. There's a lot of concern regional banks' ability to pay back the TARP because of exposure, increasing defaults on the commercial property. That's a big story we've been following, of course, of late. What's your take on it?
Absolutely. I think regional banks are going to be the last to get out. If you look within Citigroup as percentage of their loans, they have about 9.5% of the loans are CRE. When you look at most regional banks on average, it's about 37%. So if you look at what I think the next shoe to drop is commercial real estate, and many of the regional banks essentially became real estate plays the past number of years, and they do not have the capital markets expertise or operations to kind of grow themselves out on the other side. This is something that many regional bank presidents and CFOs are sweating what's happening next year. And I think many people are very happy to see this rally going forward. But in a sense, I think the easy money has been made, especially in some of these financials. Again, that the XLF up being so dramatically. I would encourage investors, if they're invested in financials, to take some profits right now. I think, you're seeing the market being a little bit tired on low volumes. I think it may be opportunistic to look at higher quality names with strong earnings and strong dividends, possibly outside of the financial sector, as a place to move into a safer play for 2010. Again, some of the financials have had a great run. If you have some profits, in some cases 60–70%, I think it's prudent to take some risk off the table at this time.
A lot of information. We thank you for it. Matthew McCormick of Bahl Gaynor. Have a good afternoon.